Good morning. Good morning, everyone.
Good morning, sir.
Good
Good
morning,
morning,
sir.
sir.
Good morning, sir.
Slide is visible.
No, sir.
No, sir.
No,
Huh?
sir. Only you are visible.
What is written on the slide?
No, sir. It's not visible.
Huh?
So we are
Slide is
not
not
able
visible,
to
sir.
see the slide.
Slide is
Slide
visible
is
or
not
not?
visible. No, sir.
No, sir.
लाहौर क्या यार मसला है तो बिल्कुल सही सिस्टम से किया क्या मसला है इस slide क्यों नहीं visible? From the bottom to the screen, we have to get the share the group. Is it visible now?
No,
Is it
sir.
visible now?
No, sir.
Huh?
No,
No,
sir.
sir.
No, sir. It's not visible.
Is it visible now?
No, sir.
No, sir. Sir, if it's visible, we will tell you.
Bro, ये problem आ Let me do it second time. Stop sharing. Is it visible?
No, sir.
Is it visible?
Visible now, sir.
Okay.
Yes, sir.
Chalo, thank God somehow. Is it changing? Is it changing or
Yes,
not?
sir. Yes, sir.
चलो ठीक Thank you.
Yes, sir.
Okay, now we should start. In the last class, I have started to discuss about this organization of finance, and I have already taken up the. Let me. That at the highest position there are shareholders. Then at the next, because the organization chart when we prepare it is like that. Next to the shareholders, there is board of directors, and next to the board of directors, below that, we are placing the CFO, sorry, CEO, the Chief Executive Officer. Under the Chief Executive Officer, there are different other officers. It will be the Chief Marketing Officer, Chief Finance Officer, Chief Human Resource. So these are the terminologies which we are using now. We are basically concerned with the finance. So from this, the Chief Finance Officer or If it is not like that, then there will be finance manager or sometimes finance vice president also, depending upon what type of designation you are going to give. Most important thing for the purpose of understanding is what type of functions they have to undertake. That part is important for us to consider. So under this chief finance officer or the chief financial manager, there are two positions which are being created. If the organization is very large and the functions of finance they have to be handled in a proper manner, then we are going to have these two positions. One is the controller and another one is the treasurer. Now in case of this controller, as I have already mentioned in the last class, the controllers are basically related with your accounting system. So the most of the accounting part that is being handled by that. So it has been mentioned here. Functions include corporate accounting, financial accounting, cost accounting, tax management, data processing management, internal audit. The chief, this controller, he will have to install the system, that how this accounting system that will operate, and these different type of decisions they will be undertaken. Sometimes when the organization is very large, you will find that we are having separate managers for all these functions. So financial accounting, there will be manager, cost accounting will be manager, then the tax management, because they have to regularly check what will be the impact on taxes when we are going to adopt one particular system or the other system, and how the tax that can be reduced. Well, this is also a regular type of function in the organizations. Data processing, because this is very important. On the basis of this data processing, you are going to, and after this computerization, this position that has become very much important. So sometimes we are going to create this IT professional, so IT manager in the accounting department. Internal audit, as we know, this is the audit which is being conducted mainly for the purpose of reducing costs. So it is related with this, the internal audit part, and all the documents, all the vouchers, they are being checked with the intention that okay, there should not be any type of exaggeration or the cost that should be controlled. So this is the accounting function which we understand. So controller, accountant, accounting, controller function. Now coming to the second one, very important part, that is the treasurer. Now see, this treasury function is something different in the organizations, or we can say that as this finance is concerned, it is the treasury function that has become important. Now see here, in case of this treasury function, the function includes capital expenditure management. What is this capital expenditure? I will be coming in detail at the later stage. See, the capital expenditure, we are using that term for the purpose of those investments, those expenses which we are making, and it takes some time in getting the complete installation, and the result of that or the return from that we are going to get over a period of time. So that type of expenses, say for example, you are going to buy land, you are going to construct the building, you are going to install certain systems within the organization, equipment, machinery, we are going to install. They will not be used only for 1 year, or they will not be dismantled in 1 year. It is requiring huge amount of money. This is one feature. Once you are going to take this decision, this is irreversible decision. That is also another feature. If you are going to reverse that, no problem, you can do it. But the amount of expenses or the amount of loss what you have to sustain, that will be exorbitant. So that's why we say that this is the irreversible decision. Very, very important part is this. Amount involved, that is very high. So, and we are calling them that the capital expenditure management. Very important decision in case of finance. Credit management. See, in case of this credit management, as I have told you at the different stages, that we are allowing the customers the credit facility. Intention is very much clear. We are giving them this facility so that they will be purchasing in large quantity. Once they will be purchasing in large quantity, we are expecting we will be earning good amount of profit out of that. But there is also, the risk is there, because the person or the organization which has purchased the goods from you, they may then go bankrupt, they may not be paying in time, you will have to go for additional effort in collection, you will have to create the collection system also. Many things are there in case of this. So bad debt will be created, which is a loss to the organization. The additional facilities will be created where you are going to write later, you are going to, sometimes you will have to go to the court also because the person, the organization to whom you have supplied these goods and services, they have not paid you. And you are not considering that they will be able to pay. So, and you consider that okay, they are not going to continue in business also. So this problem when you are facing, you will be going to the court because legal formalities they will be required for the purpose of settlement and all. So credit management is a very typical type of situation which the companies face, and it is directly related with the cash flow of the organization. Whenever you are extending credit facility, the first thing is that the inflow of cash that is being stored for that particular period for which you are allowing this credit. The inflow will not be there. And the production that is continuous, because production you are not going to stop. Okay, if the money is not coming from the customer, so I am going to stop my production, I will see it tomorrow or the after. It is not like that. You have your process of production that is a continuous one. And in that case, what you will do? Inflow is not there and everything is in the form of outflow. How are you going to manage that? How are you going to trade off the two? So it may be that you are also going to ask for credit from your supplier. This will be the one option that okay, I should get credit facility from the supplier of my raw material. But what will happen to your labor? The labor is not going to wait longer. So maybe that you are going to create outstanding labor, outstanding salary or wages for 1 month, 2 months time, but not on a regular basis you are going to do. Otherwise, they will be leaving your organization, joining some other, you will be in trouble. So the credit management is a whole lot of problem which we find in case of business, and these finance people, they will have to undertake these decisions, and they are the regular decisions. It is not that okay, one time you have decided and it is going to continue. So the treasury function that includes this, the capital expenditure management, credit management, the cash management. See, the most liquid asset of any organization is cash. Because everything, whatever is there in the form of current assets, we are going to convert them into cash. You have purchased raw material that will be processed into finished product, then after you will be selling it to the customer, that you will be creating the data for the business, then after you are going to convert it into in the form of cash by collecting from your data. So everything at the end you are going to see that okay, it should be converted into that as a part of your business operation. Whatever activities you are undertaking, as a part of business operation, you will have to convert them into cash. And the most liquid asset in your organization is this cash. You are going to maintain that. It is very important. And see the nature of cash. We will discuss in detail at the lecture, but some ideas you should have. Cash by itself is not going to generate any revenue for the business. Very simple. Very simple idea, very clear idea. Cash by itself is not going to generate. It will have to be invested. So you are going to invest in case of long-term assets or in case of your current assets. So by itself it is not going to generate any revenue. But if you are having shortage of cash, that is also not desirable because you will not be able to meet different type of obligations. If there are opportunities available for purchasing certain things, you will not be able to do that. So cash is a very typical type of asset in the organization. Most liquid asset, of course, it is there. Less amount of risk you may be considering when you are having cash. But if you are going to maintain more than required, it is not desirable because it is not going to pay you, it is not going to generate any revenue. If it is less than that, you will be in trouble. You will not be able to meet different type of obligations which are there. So how much you have to maintain, how much you are going to have all the time. So every day that much amount of cash that should be maintained. As a finance manager, you will have to take a decision on that. So cash management is very important, no doubt. It is the decisions that look to be okay, it is so simple or it is so direct. But when you will be checking what is the implication on the operations of business, at that time you will find that okay, why it has become so important and what we have to do. Financial planning, fundraising. See here, in case of this, the financial planning, fundraising. So where from the money will be coming? So this is a very important part. And the financial planning part of this. We are having different terminology for this financial planning and fundraising. In case of this, as we know that there are different sources of money to the business. Equity share is one, preference share is another one, internal resources, if the business is in operation. So your retained earning or the results, whatever you have created, this is another important source. You are taking loan from financial institutions, okay, this is one. You are taking loan from the bank, okay, that is another one. You will have to plan for that. Financial planning and fundraising. Where from you are going to collect this money? Are you going to issue additional shares? Or are you going to collect money from those shareholders who have paid only up to the allotment or up to the paid up capital, and still there are certain calls which have to be made? So what is the position? Are you interested in collecting money from them? Or you say that, okay, there is no need to collect it from them, we are going to issue additional shares, maybe possible. So the fundraising is another important part. See, in case of this fundraising, the very important part is always keep in mind, there is one thing which we always say, no money is free to the business. No money which is coming to the business is coming free. You will have to pay cost for that money. Always keep this in mind. Any amount, any money which is coming in your business, it is carrying, it is bearing some amount of cost with it. For example, if you have taken loan from bank, you will have to regularly pay interest to the bank. This is the cost. If you have taken money from the shareholders and it is a preference shareholder, you will have to pay a dividend on the profit whatever you have earned. So that dividend payment, that is the cost of your money. If you have collected money from the equity shareholder, you cannot retain the money for very long period. Unless there is a condition that, okay, in future you will be giving them a good amount of money, that will be another. Otherwise, they are also expecting that regularly you are going to pay them the dividend. So whatever money is coming to the business, they are bearing different costs. And see, the other important part is that the cost related to all these sources, they are also not same. The obligations related to them, they are also not same. The risk related to them, they are also not same. The features we will have to understand. You have issued bond or debenture in the market. Okay, 87% bond, 15 years period. No problem. So 7% on the investment on each bond, you will have to pay every year. It is a regular payment. And at the end of 15th year, you will have to pay the total amount of that particular bond also. Now you have to see that how are you going to manage this money, that every year you should pay the interest on this bond, and at the end of 15th year you have to pay the amount of bond whatever you have raised. So this is the financial planning side. Where from the money will come, where from you are going to collect this money, because obligations are different, cost is different, its impact on your total business, its profitability, its impact on the market value of the share, that is also going to be different. When you are going to collect money from different institutions, you are taking most of the time loan, so the risk related to that is also increasing. And if you are not able to create the corresponding assets, then there is higher amount of risk in that case. So this is one important part. Capital budgeting and capital expenditure, they are all almost same. So which I have already considered that this is a long-term investment. Capital budgeting manager, portfolio manager. See here, a very important part is the portfolio manager. Here he will have to see where how he is going to divide the total amount of money, whatever is there. So this division part of resources, whatever have been generated or whatever you have collected. So the portfolio, foreign exchange management, because in most of the cases you will find that you are collecting money from the foreign country, or so there are foreign shareholders, they have invested. And sometimes you are requiring the foreign exchange for the purpose of financing your capital assets. You are purchasing equipment from outside. You will have to pay in foreign exchange. How are you going to manage that? Considering the restrictions imposed by the government because of foreign exchange outflow, generally they are interested in stopping that. So in that case, you will have to manage how are you going to do that, what are the different type of restrictions, how you have to handle this, what are the different legal formalities related to that. We are going to consider. This pension fund management, see this, this pension fund is also very important because every time you are going to collect money from, check for example, your provident fund is there. you are collecting money from your employees and you are putting in the provident fund account. So it is there where you are going to invest that, how are you going to get, how much amount of return you are going to get out of that. When the person is going to retire and pension is going to be given, there should be a regular amount of money which should go to the employee. How are you going to manage that? See, all these functions. Now coming to the final aspect of this. The treasury function is basically related with our financial management. Controlling function is related with the accounting side, which is based on your accrual system, and it will start from your journal, ledger, trial balance, profit and loss account, balance sheet, appropriation account, and all the things related with the tax management, data processing, and internal audit, costing, batch costing, process costing, many type depending upon the nature of industry and all. So this is the controller side. We are basically concerned with the treasury side, where the money which is coming from different sources, which will be invested in different outlets, and the operations of business, how we are going to manage that, how much cash we have to keep in our business, how we are going to divide our total resources in terms of the portfolio, foreign exchange, pension fund, because regularly you will have to pay. Everything which is related with the flow of money within the organization. Here it is the record keeping part. Here it is basically the record keeping. But here you will have to check how this flow that is going to affect the profitability of your business, the risk related with the business, the return related with the business. So here, whenever we are talking of the organization of finance, chief finance officer or your finance manager, under him there will be controller. Then there will be another person who will be working as a treasurer. If the organization is a small, then there is no need for this controller or treasurer. Even one person, he will be handling that, he will be installing the system. And under him there will be some accountants who will be working with all this accounting system. So if the organization is very large, where the operations of business, that is a continuous one, market we are covering, like India, for example, you are covering the total market. So in that case, operations and research and developmental activities are also being undertaken. You are going for advertising of your product and services, and you are changing these advertisements from time to time. You are conducting marketing research activities. Many things which we are doing in case of our business when the organization is very large. As compared to the smaller organization, they have these activities, they are generally not undertaken. So here we are. We are at the stage of this treasury function. So the finance manager, finance function, we are here at this stage. Now I am coming to another important part of our discussion, which is very important for the purpose of understanding, for the purpose of its application and its long-term implications at the marketplace. See, by now we have already discussed that the money which is coming to the business, they are coming from different sources. The most important is there are different promoters, those who have started business, those who have conceived the idea that we should go for this business and we should invest money in this particular venture. So they have started that, and they have from the very beginning. They are generally the owner, and they have contributed in the equity capital of that particular organization. So from there we have to understand it. Okay. But they are not the only supplier of money to the business. This we have to keep in mind. You have issued the debenture also. So money is coming from the same market, but the nature of market is different. Equity market is different as compared to the debt market. In case of equity market, return will take place at later stage, but we don't know how much return we will be giving as a company. But in case of debt market, the person who is purchasing this debt document, he understands, he knows that he will be getting this much amount of return. So in this case, you will find that both the money is being collected from the market, but the person who is buying your equity share and the person who is buying the bond and the venture, their perception, their understanding, their ideas, they are not same. This is there. This is one. Even the preference shareholders, they will, because in that case it is a hybrid type of financing we say. It is having some features of equity and it has got some features of debt also. Take for example, payment to the preference shareholder will be made only when there is profit. So it is the feature of your equity. But the amount of payment which will be given to the shareholder, to the preference shareholder, that is fixed, which is not the feature of our equity, because in case of equity it is not fixed. But the fixed amount of payment, that is in the case of debt, so it is a hybrid type. So here in this case, what happens? Some features of equity is there, some features of debt are there. And we have formulated or we have designed in the form preference share. Rate of return to the preference shareholder, that is also fixed. In this case, what will happen? The risk involved in case of the preference shareholder, if I am purchasing preference share, that will be less as compared to the equity share. If I am taking loan from financial institution, bank and others, in that case we will have to pay interest on it. Whatever is our investment interest, that will be paid regularly. And the principal amount, that will also have to be paid. If you are going to pay regularly, that is another feature. Otherwise, you will have to pay at a particular period of time. Once the time is the maturity period that is coming. All these features, if you are going to consider and take into account that these are the different suppliers. Their intention to supply this money and return related to that money, that is very much clear. And in most of the cases, other than equity shareholder, you will find that regularly they are going to get some amount. Preference shareholder regularly, bond and debenture holder regularly, bank or financial institutions, they will also getting return regularly. Only thing is that the equity shareholder, they are not getting regular payment. Now, and the extreme situation is that the company is having profit, good amount of profit also, but the management decides that we are not going to pay any dividend this year, and the equity shareholders, they are also going to vote in this favor. They say that okay, no problem, we will see next year. So what happens in this case? Even after having profit, the company decides that we are not going to pay dividend, and the shareholders, they say that it is all right. Why? Because the company has already shown them that there is some investment opportunities available. There are some investment opportunities available. So we will be financing from this particular amount of profit to that particular project, and on that particular project or on that expansion or reorganization, sometimes merger, acquisition, whatever the takeover and all that. So they will be considering that okay, in future the position of the organization, that will be improved. Now see, if you are going to see all these suppliers of money, and we have already considered that no money is free to the business. The maximum risk the person who is taking is the equity shareholder. All right. Why these finance people, what they say? They say that we will have to ensure that the interest of the equity shareholder, that should be protected, because he is taking the maximum risk. He is the residual owner. He is the person who will be getting at the end. First of all, we will be paying to the financial institution. Then after, we will be paying the tax and everything we have paid to the government. After that, some profit is there, we are paying to the preference shareholder. After that, if there is some amount left, we are going to pay to the equity shareholder. So for the purpose of understanding finance, at the end point is that the equity shareholders, their interest, that should be protected. Now the question here is that how are you going to protect that and what you are going to do for that? See, one idea which we are having is that if the organization is having profit and the company is going to declare dividend, naturally their interest, that will be protected. But sometimes we are not going to declare dividend with the intention, with the idea that in future we will be doing that or they will be getting the benefit of that. Now see, there is another thing which we have to understand at this stage. the equity shareholder or the preference shareholder. It is more visible in case of equity shareholder. At the end of the year, when we are calculating profit, and what is the position of profit, based on that we are going to declare dividend. And this we are doing at the end of the year. If the company is cash rich company is operating at large scale, and there is no dearth of cash, or there is no trouble related with the cash, and the profit that is also being generated on a regular basis. So in such type of company you will find that the dividend is also being declared, not at the year end, but they are declaring quarterly also, sometimes half yearly also. So the first quarter dividend, second quarter, third quarter, fourth quarter, we are going to declare the dividend on quarterly basis also. Okay, that is also one feature which we find. But in general, what we are doing, at the end of the year we calculate this is the amount of profit after taxes we are going to distribute among the shareholders. Preference shareholder will be paid first, then after we will be paying to the equity shareholder. So this is the one return which the shareholder is getting. Okay. But for that return, which you are going to pay in the form of dividend, it may be 2 rupees dividend, 3 rupees dividend. If suppose he has purchased a share of 10 rupees, so 2 rupees dividend, 20% dividend you are going to pay on that. So, or if suppose it is 100 rupees share, 20 rupees you are going. So in this case, what will happen? After 1 year, he is going to get that. Same will be the case of preference shareholder. But when we are talking about the complete benefit to the equity shareholder, we will have to see the other component of that. The other component of the operations of finance, and the other component is at the marketplace. So these are the two components which we have to understand. One is the dividend component, and another component is the marketplace. What is there? In case of shareholders or the shares, when the shareholders they purchase share, we issue them the certificate. That is the share certificate we are going to issue them. This, when the shareholder has purchased either directly from the IPO, that initial public offering, or he has purchased from the stock market. If suppose 10 rupees share, he has purchased for 15 rupees. Today he has purchased for 15 rupees, and after 1 week, next Monday, he finds that the 15 rupees share that is being traded for 18 rupees. So what he is going to do? He is not going to wait for 1 year to keep that share. He will say that, okay, after 1 week I am getting 3 rupees benefit on this particular share. So what will he do? He will offload that. He will sell that share in the market. And he will be in a position to earn 3 rupees per share from the market itself. He will not have to wait for the dividend which will be declared at the end. So dividend is one which is coming from the organization, where the operation of business that is going on. But beyond that, the return is also possible from the market itself. The 10 rupees share he has purchased for 15 rupees, now he is selling for 18 rupees. So within 1 week, he is getting 3 rupees per share return. So he will be happy, and he will say that why to wait for this dividend? Let the dividend should be taken by some other person who will be purchasing the share at that particular stage. So on a regular basis, what this shareholder is doing, he is getting the return from buying and selling of share at the marketplace. And the marketplace for this buying and selling of share, as we know, that is called a stock exchange. So at the stock exchange, we are selling it. Now we are having, due to operations, due to this digitalization and all, directly they are over the counter, and different methods of trading, that is also possible. So in that case, he is going to buy, he is going to sell share whenever he needs that, and whenever it is under operation. So dividend is one component, and the other component is the return which he will be getting from the buying and selling of share at the stock market. this buying and selling of share at the stock market and the gain related from that is called capital gain. So the term which we use, that is the capital gain, is the gain due to buying and selling of the share. You have bought for one rate, you have got another rate, and the difference of that. If you are getting more than your purchase price, that is your capital gain. If you are getting less than that, then that will be your capital loss. Now you will say that why are you selling at less? If suppose I have purchased the share for 15 rupees today, and after next Monday, if I am finding that the share price that has come down to 12 rupees, so okay, I am at a loss of 3 rupees now, but I am going to sell it. Why? Because I don't know next Monday whether it will be sold for 9 rupees or 10 rupees. I don't know. So as a rational investor and as a risk averser, I will say that okay, please, I am going to offload it. No matter I am sustaining loss of 3 rupees. So the capital gain, it may be the positive gain or it may be the negative gain. The negative gain, that is your loss. So now whenever we are talking about the equity shareholder, in finance we are having one very important term which I have already discussed at the time of defining finance, that it is the wealth which will have to be created. Very important part is the creation of wealth. So here it is not the creation of profit only. It is not only the dividend. It is the overall benefit to the shareholder. So sometimes we also use this term, the welfare of the shareholder, the complete welfare of the shareholder. Or in general in finance you will find most of the time in the text also that they are talking in terms of wealth maximization. Now the question is that when you are operating your business, you are running it with the help of your fixed asset, current assets, and the market is there, you have collected money from, so a whole lot of operations of business you are going to consider. So in this case, most of the time, our main concern is that the profit of the organization that should be increased. Whenever we are operating our business, we are manufacturing goods and services, we are supplying in the market. Our main intention is that the profit of the business, profit from the business, that should increase. All the time we are considering. Finance people say that the profit maximization, because all the time you are thinking that okay, profit should be increased, so the cost should be reduced, so you are going to compromise on different type of costs. For example, okay, I am going to reduce the labor cost, I am going to reduce the cost related with advertising, I am going to reduce the cost related with the distribution of goods to the market. Many costs are there where you are going to compromise, and you will be able to run your business, your profit will be increased. Many manipulations that can also be made. There are many things which we do for that purpose. But in case of this, what will happen? You are going to increase the profit of the organization by reducing cost or by increasing the sales revenue or per unit sales price. And you are going to increase the sales price, there is also chance, and retaining the other expenses, profit that is going to increase. Finance people say that profit maximization as an objective of the organization, that is not a true guide for the purpose of taking financial decisions. Now I am coming to the crux of this particular aspect. What is our intention? As an operation of business, we are interested in maximizing profit. But finance people say that this maximization of profit, whenever you are going to consider, it is the limited view, and on the basis of this, financial decisions, they will not be complete, they may be misleading, they will not be giving you, they will not be guiding you in a better manner. Then what should be done? The next question is that then what should be the indicator? When the profit maximization is not the objective, then what should be the objective? The finance people say that it is the wealth maximization which is important. Profit maximization, okay. But more than that, which should be the guiding principle, which should guide us, that should be the wealth maximization. Now you will say that what is the difference? What is this wealth? Now I am coming to that particular aspect. And why finance people say that this profit maximization, that is not good, and the wealth maximization, that will be good. There are certain criticism to profit maximization. So first of all, we will have to understand the criticism part. They are very simple to understand. But the critical aspect of that we have to take up. Now see, in case of profit, the first thing is that we know about this profit. You are very much familiar with the final account. First profit is the gross profit which you have calculated. What are you doing in case of that? Out of your revenue or sales revenue, you are going to reduce the direct costs. So after that, whatever profit you are getting, that is your gross profit. All right. After this gross profit, you are going to reduce your marketing expenses. All right. Then after, you are going to reduce your administrative expenses. All right. Then you are also going to reduce the depreciation, because due to matching concept, the depreciation you are charging on your fixed assets. So you have reduced that. After payment of after considering these non-cash expenses, cash expenses, you have come to another profit. And what we are calling them now? We say that it is earning before interest and taxes. So from gross profit, you have reduced marketing expenses, administrative expenses, depreciation and other expenses, you have reduced them. So you have got another profit. What is that? It is profit before interest and taxes. After that, you are going to pay interest on the loans, whatever you have taken. It may be the financial institution loan, it may be the interest which you are paying on the bond or dividend, on the bond or debenture. So the interest you have paid, all right. After payment of interest, you are having another profit, earning before taxes. Now, after that, you are going to pay tax to the government, for sometimes 40%, sometimes 50% also. The heavy amount of tax, because we have already considered the tax biases decision. So the tax incidence, that is important. We will have to consider that. So now you are going to reduce tax from it. All right. After that, what are you getting? You are getting one profit that you are earning after tax. This is your final. Now you say that, okay, this is our final profit. It is earning after tax. This is the amount which should go to the shareholders. All right, accepted. So you will be distributing to the equity share, the first of all payment to the preference shareholder. Then after, you are going to give to the equity shareholder. But for the purpose of future development, you say that, okay, some part of this profit I am going to retain in the business, and some part I am going to give to the equity shareholder in the form of dividend. All right. Now the question is that which profit you are interested in maximizing. It is the gross profit. Then what will you do in that case? Sales revenue is already there. You may increase the selling price per unit, but you are operating in the competitive market, which we have already considered. The customers will be leaving you because they will be getting better products from the other suppliers in the market. Your position, so up to a particular limit only you can increase the price of your product. Okay, you will say that I am going to reduce the cost of production. So the material cost, the labor cost, direct, we are going to reduce it. Okay, but there is also a limit to that. So gross profit, you will say that it is not the better indicator. After that, you have reduced the administrative and marketing expenses. Depreciation also you have charged. Operating profit now you have got from this gross profit. Are you interested in reducing this operating profit? But after that, you will have to go for the payment of interest. You will say that, okay, I will try to reduce my interest incidence. All right. So somehow you will be managing that less amount of interest to be paid. Some sources you are going to identify and tap. And you are getting money from there. Accepted. You may be reducing that. But after that, you will have to pay taxes. So you are also managing the tax consideration. So tax incidence you are going to reduce somehow. So you may be purchasing certain type of assets which are being supplied by the government, and they say that, okay, we will be reducing tax on that. So you may be purchasing that, you may be investing into that infrastructure, like that. You will be doing that. So now you can say comfortably, you will say that, forget about everything. We are interested in the profit after taxes, because from there, whatever money is there, we will be paying to the equity shareholder. Now see, the question is, that this is the profit itself. There are different type of profits. So some amount of confusion is there. The finance people say like this. The second part of this profit maximization, they say that which profit are you talking? If we are going by the terminology which we are using from the economics, that whether you are interested in maximizing short-term profit or long-term profit. Because we in business, sometimes when we are starting business, we are operating in the market, we supply our goods there, and we are not in the monopoly position, then what we are doing? In the beginning, 1 year, 2 years, 3 years, even we are sustaining loss, we say that, okay, let us see. We have to wait and watch. So in short term, sometimes you are finding that you are at a loss, but even after that you are continuing your business. So which profit you are interested? Then in that case you will say that, okay, I am interested in long-term profit. All right. So some organizations, they will say that we are interested in long-term profit, no matter in short term we are having loss, but we will continue with that. But here in this case, so long-term profit, that is another important aspect. So the profitability calculation is one side, the short-term profit and long-term profit, that is another side. So the criticism which the finance people they are putting forward is that whenever we are considering this profit maximization, then in that case the profit can be manipulated, that can be increased, that can be reduced by doing certain things. And sometimes it will also happen that you can increase profit by not undertaking certain type of activities which are required. Because, take for example, research and development, we generally give this example. You say that, okay, I am going to reduce expenses on research and development. Okay. By doing that, what will happen? Your expenses, they will be reduced. All right. So ultimately, the profit amount that is going to increase. But this research and developmental activity is so important that if you are not going to undertake, the future of your business, that is at stake. Because the changes they are taking place, technology is changing, marketplace is changing, customer preferences are changing. Many changes are taking place, which will be taken care of by the research and development institution of your organization. That part, that component, that will have to take care of it. And you are spending money, less money you are going to spend there. This research and development activity, that will be reduced. Advertising, you will say that, okay, I am going to reduce advertising expenses. Then what will happen to the awareness? What will happen to the preference of the customer? Because once you are going to reduce this advertising expenses, so awareness of the customer, they will be reduced. The preference for your product and services, that will also be reduced. So here what they say that, okay, profit, that can be manipulated also. That you can increase profit. But there are certain things which you are going to undertake, which will be detrimental to your future interest, that will be detrimental to your future development. But you can say that, okay, we will be increasing profit. Considering this is the background in which we are going to consider, there are certain criticism which the finance people they are putting before this profit maximization as an objective of the organization. They say that no, profit maximization is misleading. It is the wealth maximization of the shareholder. We will have to have interest on that. We will have to focus on that. Now I am coming to that particular aspect.
Excuse me, sir. Hello. Excuse me, sir. Sir, we have another class to join now.
Profit maximization, short run, long run, criticism of profit maximization. Total profit for the year or earning per share for the year, profit can be calculated. I have discussed this part. Timing of the profit, we have already considered this. So these are the criticism related to that. Criticism of profit maximization. Yes, please tell me. Hello?
Sir, we have another class now.
You are having another class?
Yes, sir.
Okay then, what is the time? 5 minutes.
Yes.